Thanks very much, Scott. Yeah, I'm here with Gary Cohn, former head of Goldman Sachs, former NEC, and now blockchain entrepreneur. We'll get to that in a minute. Let's talk about these markets here. 340 down right now. Last week was a sort of unsettling week as rates came up. How do you put all of this into context here?
You know, Steve, look, I think the market's trying to find a level that it's comfortable with. We had a fairly large rally at the end of last quarter as people anticipated good earnings in the quarter. I think we're getting the good earnings. We've seen 10 years move up. We've seen it sort of settle in this 3.25 range. I'm not saying we're in a sustained 3.25 range, but I think there's a lot of news in the market. There's a lot of details, and traders right now are trying to find a sort of I'll use a great word, a neutral level.
We can come back to that idea of neutral level in a minute, though. When you look at the 10-year at 317, is that going higher in your opinion?
I think it's going higher, but I think that if you look at the Fed and what they've done on their forecast and what they're telegraphing to you, there is probably one more rate increase this year. Look at the dots next year. I'm not completely sure that the Fed's going to meet their targets for next year on the dots. But I think if I were sitting in Jerome Powell's seat, I would have put out the 3 dots for next year as well to give himself the latitude to move rates if the labor market continues to tighten and we see inflation come through the system, both in commodities and wages.
So in your mind, do you have a price in your head, or a rate in your head for where Fed funds go over this cycle? How high do they go? And what happens to the 10-year in response to that?
Look, you know, everyone wants to talk about the normal rate for where we are. You know, we're 2.25 now. Could we get a Fed funds rate to 3%? Does that seem sort of normal to me? And am I smart enough to say it's exactly 3%? It's somewhere 2.75, 3,
right.
Maybe 3.25 sounds like the area. You know, we all knew what an easing period looked like. We knew that zero and negative rates was a very easy period. And the Fed clearly stayed there longer. They clearly wanted to put liquidity into the system. The Fed clearly wants to take it out now, and I think that's what they're doing. But I also understand that they want to do it in a methodical basis, and they want to be very transparent. So, you know, I think we'll gravitate to the high 2s, maybe low 3s.
What happens? I know you like to look at individual stocks, but what about the stock market in that context? A 3% funds rate, the 10-year is going to be somewhere over that.
Yep.
Is that a bad environment for stocks?
I think it's a good environment. So if we have a 3% Fed rate and funds rate, and we have a 3.5 plus 10-year rate, let's call it 3.5. We have a 50 basis point spread in there, and we continue to see the economy grow. We continue to see earnings grow. We continue to see companies invest in the labor force, and we continue to see wages grow. I think that's a great environment for us to live in.
So I think we need some disclosure here. There's a lot of guys on the Fed, and women as well, who you were involved in picking. So you were involved in setting up this Fed board when you were so that's to lay the context for this question here. And there's 2 parts to this question. The Fed says the Fed is crazy, that it's moving too fast. First of all, is the Fed crazy, and is it moving too fast?
So I'm gonna quote something that you've been talking about on air, which I think is completely right. If you looked at what the DOT program was a year ago, and I would have told you that we're basically 25 basis points higher than the dots a year ago, but GDP's 1% higher, and unemployment's 1% lower, you would have told me I'm crazy. You'd say, no way we're 25 basis points.
More than 25.
We'd be substantially higher.
That's a story I did on Halftime Report last week.
Yeah,
right?
I mean,
exactly.
If you look at what's actually going on in the economy, when you look at the real numbers, we're way exceeding on growth, we're way exceeding unemployment, and the Fed is basically on target. It seems to me like the Fed's in a methodical rate-raising environment. Exactly what they're supposed to do.
The president's wrong that they're not crazy?
I think the Fed's doing their job as a very independent agency.
And there's another question that's inside that question, Gary, which is, should the president be making these comments? I did notice that when you were there, the president wasn't making a whole lot of comments on the Fed.
Look, I believe very much in the setup of the U.S. government, in the branches of the government and the independent agencies. And the independent agencies are very independent. The president's powers and the executive power is to appoint and have confirmed his individuals that he wants to serve on those committees or those boards. Once the president does that, and he can put anyone up he wants as long as he gets them confirmed by the Senate, it's his job to leave those committees alone to do their job. They are acting in the best interest of the United States. And I think he firmly believes he picked the right individuals to act in the best interest of the United States.
So you don't think he should be making comments on the Federal Reserve?
I don't think he should make comments on any independent agency.
The Federal Reserve acts as the president can fire the chairman for cause. Do you think this president could fire the chairman?
You're asking me constitutional law, and I'm not a constitutional law expert. I don't think he has the ability, but I could be wrong.
Let's talk about something that one could say, oh, I think you said it, precipitated your departure from the administration, and that's your disagreements with this administration over trade policy. How much concern do you have that we're just doing this negotiation or these discussions with China in the wrong way?
Steve, as you and I well know, we are a service economy. Our economy is driven by service. We're 80+% of our GDP, 80+% of our job creation is services. So when you're a service economy, the way to stimulate your economy, the way to grow your economy is to allow consumers to buy goods as cheaply as they possibly can and use the rest of their money to buy services or, if they're lucky enough, to save. Anything that raises the price of a good doesn't make sense for our economy. Even if they're paying it to the government as a tariff, it's just another tax.
But the proponents of the administration policy right now would say, look, we were trying to get them to do concessions on or change their policy when it came to the theft of intellectual property and that kind of stuff, and it wasn't working, so we had to play hardball.
Look, and the president and I completely agree on the theft of intellectual property, on forced technology transfer, on lack of access for U.S. companies into China. Look, our competitive advantage in the United States is we invent things. We create companies. We create a lot of intellectual property. We can't buy goods from China and pay them for them, and Chinese steal what we manufacture in this country, which is intellectual content. That's not a fair relationship. So the president and I completely agree on what has to be done. We just may not agree on how to get there.
Do you have, you feel like the outcomes from these tariffs are going to be negative for the U.S. economy?
Again, if they raise the price of goods,
right,
it's not good for our service economy, and it's not good for savings. We look at the savings rate in the United States. We want it to go higher. If we look at the job creation rate in the United States, we create jobs through services. When you look at the last JOLT data that we always talk about, the big increase is we saw more need for workers in business services. We saw that number
go up.
Not manufacturing. In fact, we saw more voluntary leavers from the manufacturing industry, because as the job market tightens, people will voluntarily leave the manufacturing industry and they'll go into the service industry.
One of the big debates right now, and I think it kind of separates economists from maybe traders and politicians. Economists still think this economy is a 2% economy. President Trump has said we can do 3, we can do 4, we can do 5. What's your outlook on how fast this economy can grow without creating inflation?
Well, I don't think we're 2, and I don't think we're 5. I think that we've got lots of opportunity right now to be in the 3 to 4 range. And I think we can, if we can normalize in a 3+, that's what we've talked about. We've talked about taking this economy from a 2% non-grower to a 3% economy. 1% of GDP makes a huge difference to wages, to the debt, to employment, to current balance of payments, and to tax revenues. That's what we're trying to do. We're trying to move the needle by 1% to make the United States more competitive in the world.
But right now, the deficit numbers are really going through the roof here. And are you, is this not what you had planned when you engineered or were the architect for these tax cuts?
So remember, when we did the tax cuts, we talked about, and then when we modeled out the tax cuts, we had taxes going down in the beginning years. We just cut the tax revenue, the tax rate on corporates from 35 to 21. But more importantly, Steve, we incentivize companies to spend capital in the early years to create property, plant, and equipment to go out and stimulate more jobs, stimulate higher wages, put people to work that would create long duration revenue that we'd be able to tax. There was an incentive in there to spend money early in the tax plan.
So you think that taxes revenues come back is what you're saying?
We do think tax revenues do come back. And by the way, if you look at the tax revenues, even the deficit projection that Office of OMB put out, revenues were not down. Revenues were up slightly for the period of time. When I look at the deficit, I look at it more as a spending problem. And in fact, I think the president recognized that. I saw, that he told all of the agencies that they need to cut their budget by 5%, which is exactly right. We've got a spending problem in the United States.
Back in Englewood Cliffs, they have some questions for you. Scott?
Gary, it's good to have you on the program today. It's nice to see you again as well. Thanks for being here.
Great to be with you, Scott.
I want to go right off what you were just talking about, what the president said yesterday. He's going to ask all of the cabinet heads to cut 5% of their budgets. We can't take that as recognition that the deficit is going up faster than the administration thought, that revenues aren't nearly as much as the administration thought they should be in this kind of an economy. If you can't have revenues increasing dramatically over the prior year in what is now a booming economy, when can you?
But Scott, look, when we designed the tax plan, we knew what revenues would look like in the beginning. This is not a mystery. We modeled this with decline in revenue up front. We gave people 100% expensing of CapEx over the first 5 years. We put real incentives in the system for businesses to go out and spend and create wage inflation into the system. We also do have a major expense side problem in the budget. And whether we cut taxes or not, we would have an expense side problem in our budget. And I'm glad that the president's asking all the cabinet secretaries to go out and cut by 5%.
You don't feel like this is an admission in any way that maybe you guys were wrong in the way that you sold the plan, from the Treasury Secretary saying that the tax plan is going to pay for itself, it's also going to pay down the deficit, whether it was the majority leader or the House Speaker, or the way that this plan was sold in the first place?
What I'm happy with is the president is now starting to recognize we have a spending problem. We're no different than anyone else. When your revenue is X and growing at a certain rate, and your expenditures are Y and greater than X and growing at a faster rate, you've got to deal with that problem. We have to deal with the spending side of the equation. And I'm very happy that the president is telling all of us that we have a spending problem.
Did the president ask you, or did he say just run the presses, print money, Gary, as Bob Woodward alleges in his book?
Look, the president wants to grow the U.S. economy. The president ran on a platform of growing the U.S. economy, bringing jobs back, and creating wage growth. And you're seeing that. Look at the data now. We've got over 7 million unfilled jobs in the United States. We're finally starting to see some wage growth in the system.
I get it, but did the president ask you to do that to deal with the deficit?
The president wants to grow the economy. As I said, the president really was interested in growing the economy, doing what he could within his powers to grow the U.S. economy and bring jobs back and create wage growth. That was his plan. That was his mission.
Joe Terranova has a question for you, Gary.
Hey, Gary, thanks for coming on today. And first of all, thank you for your sacrifice to the country. You're a patriot. But let me ask you about the markets themselves. You mentioned before the Federal Reserve, and Steve knows this well, the Federal Reserve and global central banks have provided massive liquidity to the markets over the last couple of years. Should the markets right now be concerned about an absence of liquidity as there is that withdrawal? Because investors have been comfortable over the last couple of years on any market correction. The Federal Reserve is going to be there. The liquidity is going to be there. It seems as though this time around it's different, and we might be dealing with a liquidity crisis. Do you agree with that?
Look, I understand where you're coming from. I don't really agree with it. The Fed is in a long-term wind down of their balance sheet. They've very clearly stated how they're going to wind down their balance sheet. There's an enormous amount of liquidity still in the system. We've seen billions upon billions, or hundreds of billions of dollars repatriated back into the U.S. system. We're seeing an enormous amount of buying in the long end of the yield curve because pension funds are now getting funded by some of this repatriation. There still is liquidity in the system. I'm not worried that the system doesn't have enough liquidity in it. In fact, I'm almost still worried about the other side. It seems seems like there's too many dollars chasing two deals. And when you look at some of the asset classes like real estate, where cap rates are still very low, and other areas, you've got a lot of dollars competing for the same assets.
Gary, I want to ask you 100 specific questions from some of these books that have been written about the administration, but I want to keep this focused on what investors need to know. And the impression created by these books, Fear and the Michael Wolff book, Sound and Fury, I guess, a couple other books out there, create an impression of a White House where the internal process is chaotic. And I want you to answer the question, if you're on the outside of that process, trying to make decisions about policy, trying to make decisions about national security, are they painting the correct impression of a White House that internally is as chaotic as these books make it appear?
So I think this is an area where the press spends too much time and tries to overanalyze. Because in many respects, what you see from the president is what you get. You know, the president is very open to hearing as many different ideas on a topic as he can hear. That's the way he has run himself. He has hired people in his administration that have fairly diametrically opposed views on many, many topics. The president is willing to hear those diametrically opposing views, and he's willing to be the ultimate referee and the ultimate decision maker, which he is. He's the ultimate decision maker, and he's willing to hold himself responsible for making the decision. People portray that as chaos. I'm not sure it's chaos. It's people expressing their point of view, trying to drive a room full of people to a decision that they have a strong view is right and the other side is wrong, where the president sits there and gets the ability to digest that. But the president is very transparent. You know, you see it. Some days he says he wants to do X. Some days he says he wants to do something different, because he's basically digesting the different points of view.
Do you still see yourself as a supporter of the president?
Look, there are many things that he's doing that we completely agree upon. I completely agree on the deregulation agenda. I agree on the tax agenda. I agree on the ultimate goal with China and what we're trying to do there. So the president and I share a lot of common goals together.
Gary, you've been very kind with your time. I hope this is not the last time you come join us here on CNBC.
Thanks for having me,
Certainly
Steve.
have time for it. Thanks very much.